Uh, James Schreiber is with Financial Services of Virginia. That's our team. And this presentation is about MetLife, and hopefully it'll mean something for some of the people. We do also have some questions people are sending in those as well. So without further ado, the world-renowned speaker, James Schreiber.
Thanks, Tom. I appreciate it. This is a small group too, so if y'all have any specific questions, Tom will be monitoring it as well as Brian. Feel free to unmute yourself. Feel free to ask us. This is a very high-level presentation, but we want you to leave this for the next 45 minutes out of here knowing specifically 10 ways to kind of set ourselves up for financial success and really some good tips overall too. So we'll go through the presentation, but we'll probably give you some tips outside of it too, just as you kind of start through things just to start being aware and look for. So we'll get started. So what to expect from today, this is the group workshop. Everybody's situation is a little bit different. So we give a lot of broad recommendations, a lot of broad things to look at. Your individual situation is going to be a little bit different from that. So if you have any individual questions, if you want to sit down with one of us to kind of talk through it, feel free to reach out to us. We'll give you a way to communicate with that as well towards the end of the presentation. So tip number one, and why do we set this up? We want to set ourselves up for freedom and flexibility. So we want freedom and to have the ability to purchase what we want, to have the ability to have emergencies paid off. We want to have the ideas to really not make sure we're locked up in one situation. We want flexibility too. We want to make sure that we're not saving all in the wrong areas. We want to make sure we're not in a place where we can't access our money. If we do those two things together, it's really how we start creating good saving habits. So really starting out now and starting out early is out of all this stuff, starting and really looking at it and figuring out what you're on track for, what your goals are, is going to be the best thing you can take away from this. Waiting until you are 30, 35, 40, 45 to say, well, maybe I should start saving, maybe I should start looking at retirement. Not that it's too late, but it's definitely, the sooner you start, the better off you can be, and we'll kind of talk through that a little bit as well. So, first step we're going to do, it seems kind of easy, but we're going to look at our paycheck. If you just started out, you may see all these numbers and go, what the heck does all this stuff mean? Generally speaking, you're going to have your company's name. You're going to have the paycheck, the pay date. You're going to have the holiday hours, the pay hours, the overtime hours. You're also going to see really where the taxes are coming from. Federal tax, state tax. Ones I want you to really notice is 401k contributions, medical insurance, making sure you're putting money into retirement. If you are, how much is it, what's going into it, and really getting a good understanding of where your money's going. They want to really make sure that, you understand where your flow of money is going in order to know how much you have in savings, how much you have the ability to put away, how much you have the ability to put more additional into the 401k, and making sure you're putting the stuff in the right area. Taxes also are a big concern because we want to make sure that we're not putting too much into taxes, but also we're not putting too little into taxes. Really think about it this way. If you get money back year over year, you're actually giving a loan to the government. If you pay money, you're actually owing money. So we kind of want to do a fine balance between not owing them any money, but also not getting any money back. So it's really important you kind of study this, see where your funds are going, see how things are allocated from that end. This one is important, and I think we talked about it last time if you're on the last seminar, creating a budget. If you haven't had the chance to create a budget before, we have one that we'll put together to send out to your way that you can kind of go through piece by piece to really kind of look at everything as a whole. You really want to separate the big thing is needs versus wants. So the way we kind of like the analogy that we use, especially in the retirement, is paychecks versus playchecks. So your paychecks is what are your needs? What is the money that has to come in to pay the bills? What has to pay car, student loans, rent, mortgage, groceries. We want to kind of put that category together of what do we have to have come into our bank account to pay all our needs. Our wants are our paychecks. Those are our fun stuff. That's the stuff we save up for. That's knowing exactly what we need and to start building an asset for to use later on. So the biggest thing and where people get messed up with budgets is they kind of put the wants together with the needs. So really putting both into two different areas, reviewing your budget, and then do an accounting system too. Once a month, kind of go through your budget, see how you've done. It's not like the most fun thing to do, but you want to actually go through your budget, not just set it and say this sounds great, but how did you do month over month? Were we over budget? Were we under budget? What do we need to change? If we're taking advantage and looking at this month over month, we really have the ability to take hold of where our money's going and what we're doing from it. So the next, number 3, is going to be called Rule 2836. I don't know if you've ever heard this. If you've started the housing process, looking at talking to lenders, this is mostly the rule that they use. Pretty much what it means is that the general guideline is 28% of our income should be used for housing. So that's going to be rent, mortgages, really making sure that we understand that that's kind of the goal and that's what lenders look at. The 36 is that's the total money that we want and should have allocated towards debts. So you're going to add your car loans in, student loans, credit cards. So we're trying to keep our total debts, not necessarily the amount that matters, but the monthly payments. Right? So we want 36% of our monthly income to go towards total debts, and 28% of that 36 should be allocated to the house or home or rent. So really starting to see in your own personal situation, what percentage of the money you have monthly is going towards debt, and then what of that debt is going towards the housing side. So these are guidelines we're trying to get. It's a goal. If we look at it and we say, well, we've got a lot of student loans, we've got a lot of credit cards, really, like I said, going back to that budget, starting to figure out how much we can put away to really try to get to these 28 and 30%, 6% guidelines going forward. Once again, kind of just goes in more detail. Households should not spend more than 28% of gross monthly income on your housing expenses. Total debt, student loans, credit cards, etc. should not exceed 36% of monthly incomes. Your budget for housing may depend on your income and how much debt you have. So they really, and as you go through the process, especially on pre-qualification, they're really going to look at your debt to income ratio and seeing how much monthly debt you have versus how much monthly income is coming in. That's really what they're looking for, is to stay within that 28% guideline. How to do your important why is it important to do a budget for housing costs? You really want to look at this in the budget and see if you're about to transition into a house, what can you afford? What are you paying now? And does it fit within that 28% bracket? You can always stop buying. These are the once again new clothes, put off a vacation. Housing costs are fixed. I'm a big proponent of looking at it. Housing market's a lot different than it used to be. It's very, very competitive out right now. So it's tougher to get into the housing market compared to it was 5 years ago or so. But if you can get in, you can lock in at a 30-year rate, you're now buying an asset that's never going to go up. We know rent goes up, but the actual mortgage itself, stays level for a 30-year period. Now, taxes may go up, escrow may go up a little bit, but the actual mortgage itself stays level, which is a really nice thing as we kind of go through an inflationary period, as money continues to grow on the overall cost of living. So think before you even start looking at properties. The biggest mistake that people make is they find a property, they fall in love with it, and they haven't done their homework. So step 1, like we said, do the budget. Step 2 is take that budget and apply it to the 28 and 36% rule. See what we're on track for on that side. Then go and get pre-qualified. So work with somebody to give them your numbers, give them your budget, figure out what you can afford, what you're pre-qualified for. General rule of thumb is take your salary. If you're married, take both salaries together and multiply it by 2.5. That's generally around the housing area we should start looking at. But then there's this room with interest rates being so low as they are now, probably a little more wiggle room with just the monthly payments itself. But really do your homework before going out, falling in love with the property, and not being in a good position to sort of start that process. Consider whether or not to be house poor. That 28 and that 36, that's a big number, but we don't want a situation where we take all our savings, we take all of our income, we're paying the house, and now we can't afford the furniture, we can't afford mortgages, we have an emergency. We need to make sure that we're living, in a place where month to month it's affordable, but also we have some wiggle room as well. So we look at our incomes, our expenses, our lifestyle. We have to look beyond just what the mortgage cost is. Savings, this is the big one. a lot of people we sit down with, savings comes last. I want you to kind of really put savings up to the top. When we do a financial plan, when we talk with somebody, especially starting out, the goal, and this is a goal, not an overnight thing, this is a goal over a few years, is to have 3 to 6 months of your living costs in savings. Okay, that covers an emergency, that covers opportunities, that gives you cash on hand to get to, that doesn't have any penalties or have any immediate taxes to it. So if you say, well, I never thought about savings, where do I start? Saving $50 a week is a good start. If you're not saving anything, saving $50 a month. Just start putting something away into savings. The more you can put in and really try to get to that goal of 3 to 6 months of living expenses gives us a lot more opportunities for, if there's an emergency, if the water heater breaks, if you need new tires, if the car breaks down, we want to have flexibility in cash. We don't necessarily want to go to the debt side of things. So really start doing this. And the other thing too is that we do this presentation because Americans as a whole aren't that great at saving. 39% of Americans don't have enough savings to cover an unexpected $1,000 expense. So start out small. If you're one of these people, like I said, $50 a month gets you to $600. 2 years, it's $1,200. If you can do $50 a week, that's $2,500 in savings at the end of the year. So really put a focus on it, put it in the budget, build it as a need, and say, I need to save X, Y, Z on a monthly basis. Once we hit that 3 to 6 months of living expenses, we can slow down that savings a little bit. We can start looking at other areas. We can start budgeting it somewhere else, but we need to get that at least to cover some of the major issues if anything happens. Invest early, invest often. I really like this slide. It kind of shows us the power of compound inflation. It shows us the power of starting out young. When I first started this presentation, I said the most you get out of this, just start saving, start adding money into 401ks, start adding money into retirement accounts. If you said, I want to be a millionaire by age 65, how much money do we have to put away per month to be there? Well, for 25, we only need to put away $381 a month. That assumes a 7% annual rate of return inside of a 401k, IRA, compound monthly inflation. Look what happens when we wait 10 years. We go from 381 to 820 a month that's now required. If we forget and, enjoy those 20 years, don't really save, now we're at 1920 a month. And if we're at 55 and go, maybe I should think about retirement, we got to put away $5,776 per month. So, where would you rather be? Where would you rather start? Starting out earlier helps out. And it doesn't have to be 381. Like I said, I think it's having some in savings, having some towards compound inflation, which is going to be your 401ks, your IRAs, really building this into the budget too. If you don't know what you're putting away, go back to that paycheck, see what's coming out on a monthly basis towards the 401k side, towards the retirement accounts. If you're trying to pay student loans off, this is the big one, especially now. We all got a little bit of a break from student loans with the coronavirus. They do, right now as it stands, are coming back to the mix in September. But right now, you don't necessarily have to pay if they're federal loans, and the interest rate isn't accumulating. But we will go back to where those are going to be required. What we try to really recommend or avoid is paying substantial amounts towards the student loans and harming or reducing the overall savings or retirement. So, put some towards student loans, make a plan. When you delay savings, you'll miss out on benefits of compound during those years. Careful planning, you can tackle student loan debt and save for retirement. We just don't want to do one over the other. There's a happy medium where we can kind of do a little bit of both as well. Why invest early and often? This is inflation. Purchasing power diminishes and prices increase. So what will a dollar be worth in 10 years? 67 cents. 20 years from now, it'll be worth 45 cents. 30 years from now, that same dollar will be 31 cents. Prices increase. So how much will things cost? In 10 years, a dollar will cost $1.49, $2.22, or $3.31. So this is how inflation works. We have to keep up with it through the power of investing, through increasing our 401ks, to making sure we're putting money away. So the earlier we start, the more of a hedge we have against our dollar going down or the prices going up as well. The 3 places you can put money. There is what is called taxable accounts. which is going to be your checking accounts, your savings accounts, individual stocks, mutual funds, individual bonds. All this money goes in after tax. Your employer pulls the taxes out for you. If you get some growth in here, you get a 1099. If you take money out of these accounts, you get a capital gains tax if you hold it longer than 12 months. Tax deferred accounts, money goes in before tax. So your employer's never pulled taxes out for you. Year over year, you don't get taxed on it. So if you put $5,000 in this bucket and it grows to $10,000, you don't pay taxes on that growth. But when you do pull the money out at age 59 and a half, it's 100% taxed. If you touch it before 59 and a half, there's a 10% penalty on top of that. Most people save in these two areas. There is a third bucket, tax-free investments, which is going to be Roth IRAs. It's going to be sometimes cash value life insurance, 529 college plans, for older individuals, municipal bonds. All this money goes in after tax. So it's just like this one. Your employer's already pulled the taxes out. How it's kind of a hybrid like this one, it grows tax deferred. So you put $5,000 to a Roth IRA and it grows to $10,000. You don't pay any taxes on that. But the really nice benefit, you pull the money out, it's 100% tax-free. So we want to make sure we're seeing where our money's going. Is all of it going into taxable? Is all of it going into tax deferred? Do we have a mix here, or do we have any tax-free money? Being that most people are younger on this call, with our national debt, Medicare, Medicaid, Social Security, the idea of taxes staying low in our retirement is kind of hard to see. So we don't know for sure, but it'd be good to have planning of tax-free income, taxable income, and taxable income and tax deferred. So we just want to be making sure we're investing in all three concepts. Make sure if you haven't, sign up for your 401k, 403b, IRAs, whatever the benefits you have. Make sure we're adding to it. Make sure we're going up to matches. If we had an old employer before, make sure we understand where our money is. What is it doing for us? Do we need to roll it over? Do we need to put it with our current retirement plan? Really make sure you're just taking advantage of the match and what's out there for you. If you look at everything, you say, well, I'm saving. I've got a great budget. I'm in line. I'm on track for the house. I've got a little bit of extra wiggle room. I've hit my 3 to 6 months of living. Where should I put some money? Well, if you got long-term money, a Roth IRA is a really good place to look at. Contributions are made with after-tax money, so it's coming out of your checking and savings. Withdrawals are tax-free in retirement. For younger workers, tax deduction values, traditional IRA is reduced, and you can access the money without a penalty before retirement. So that one means we put in $5,000. My same example, it grows to $10,000. Well, that original $5,000 we put in, we've already paid taxes on that. We can get that money out without any penalty. If we took the total 10 out, we would just have a 10% penalty on the growth. So your principal is penalty free. There's options of getting the money in an emergency. Roth IRA is a really good place to start looking at for overall places to save. Make sure you're covered. Understand how much life insurance you have through work. If you have life insurance outside of work, make sure you have enough to cover the bills in the event you're passing. Make sure if you have a house already, if you have kids, if you have a family, you're having that conversation. Figure out how much life insurance you need and see if you're there already. Disability insurance as well. Our goal is 65 to 85% of our salary. Make sure we understand how much we have and are we on track to cover that in the event of a disability. On the credit score side, our goal is really 760 or higher. This can really be affected and change fairly quickly. So if you're on the lower side, there's some things you can do to really help the situation and increase it. The big stuff is paying your bills on time. Making sure the monthly payments go in and we're paying down our debt. We don't want a situation where if we miss a month or two on accident because we didn't pay attention to it or we missed something, that hurts a little bit. So also make sure your credit report is accurate. There are tons of times we sat down with people and had the situation where there was stuff that wasn't removed, something had to be changed. So there's different ways you can get your annual credit report to just look at that and make sure, identity theft too. Make sure nobody stole your identity, and now you have a situation where you really need to clean up the credit report. Have distinct saving goals. Determine your goals. How much will you need to reach them? Create a timeline for each goal. Have separate accounts for various goals. I know a lot of people and clients that have a vacation savings account, that have a new car savings account, there is nothing wrong with separating, have multiple accounts to put them in your goal to know I won't touch this because it's for XYZ. Having a goal like that really puts you in a good position. So let's talk about the 10 key takeaways and the overall sort of recommendations and what we want to look at. Step one, let's look at our paycheck. Where's our money going? How much is going towards benefits? How much is going towards taxes? How much is going towards our savings? Really getting a grasp of where our money is going. Create a budget, understand the difference between needs versus wants. So first step, create that budget. I even take a highlighter out and separate it, say what's a need, what's a want. Make sure we got those needs covered. Add savings to needs too. I know that's number 4, but adding savings in the needs section is really important. Consider housing costs relative to your income. Remember the 28-36% rule. Only on purchases that when you sure you can afford. Establish emergency fund. If you're starting out, like it says, $50 a week. If you have nothing in savings, start at $50 a month. Just start putting something away. Get used to the habit. Increasing it every single month really puts you in a good spot. Become a millionaire by age 65. Take advantage of early compounding. Add money in as soon as you can. The more we can put in earlier, the higher benefit we're going to have. Make sure we're signed up for employers' retirement plans. We're taking advantage of matches. If we have old plans out there, establishing where they are, considering rolling them over to your current accounts. If you've got a budget set up, if you've got savings set up, if you're still in a good place where that's already covered, look at Roth IRA as an option for an alternative to have some tax-free income in retirement. Make sure we understand our benefits, our life, our disability insurance coverages to where we have enough protection that's in place. Maintain good credit. Make sure we're doing the right things and develop our savings goals piece by piece. Look to the future with confidence. Don't be afraid to ask for help. We're here to help. If you've never done a budget, if you want to go through some stuff, if you've got an old 401k out there, if you want to talk about your benefits, your match, how it all kind of works. If you said, hey, I've never seen a financial plan before, that's kind of the part of this program too. So we're here to help any way we can. Shelly's not on today, but if you want, there's 2 ways to kind of reach out to her. Either that Calendly link, or if you take your phone, that QR code, you hover the camera right over there, it goes right to our calendars. But we're happy to kind of sit down with you for a little bit to go over any questions you have on an individual basis. Tom, anything I missed?
No, you did a good job. I appreciate all your help.
Anybody have any questions? Anybody else that I know we got about 4 or 5 minutes or so? Any questions? Anything specifically?